folks, and welcome to the Contrarian Trader. This is Robert Desmond. It is Saturday, September the 19th, 2009. Folks, before we get into the charts this week, I just want to take a brief moment just to go over a bit of news that I've just found so appalling and uh, outrageous that I have to speak of it. Uh, we need to keep in mind that the United States just came through the most difficult financial crisis since the Great Depression, if not in its entire history. And we have a president of the United States who is just so arrogant, who has decided that we don't need a missile defense shield. Going into when I went to bed last night, I felt safe and comforted in the idea that, you know what, at least we have a missile defense shield to protect us against the Iranians. We don't have that anymore. He's put a stop to it. He's put the kibosh on it. It will not happen under his watch. This arrogant liberal elitist has decided that we don't need it. He knows best. But what he will do is push his liberal socialist agendas down our throats, even though we have taken to the streets in repudiation of those very same policies. This is arrogance at its peak. And unfortunately, this is going to be the undoing for this president. And unfortunately, we are going to have to pay the price for it. And it's only a matter of time before this market begins to react to these policies. And we're going to discuss a couple of them tonight, and the first of which is going to be the 10-year bond, but I'll get to that in a minute. First, let's take a look at the Constitution, really quick. Section 8 of the Constitution. The Congress, the federal government, shall provide for the common defense. Provide for the common defense. Nowhere in here does it say shall provide medical for everyone, including illegal aliens. This is an outrage. Please call your congressman. Let them know they are all these congressmen up for re-election next year. Get on the horn with them. 1/3 of the Senate is up for re-election next year. Get on the horn with them. Be heard, please. And now on to the stock chart. I'm sorry, I get so heated about this. It's just so enraging. The only thing that's second that enrages me more than liberal leaders is our money managers. These mutual fund managers are so arrogant. What they're doing is they're jumping in and they're buying right at the height of this cyclical bull market. This bull market, which is coming to an end. We're heading into steep resistance. What they've decided to do is to throw more money at it. And how do I know it's mutual funds that are throwing money at it? It's simple. I mentioned last week that we were coming up against resistance at the 1040 or the 1050 level. Last week we popped up over 2.5%, or close to 2.5% on the S&P 500. We broke through the 1050 level on high volume. Now look at this. You had all these consecutive months of down volume, or declining up volume, and last week you had this spike of volume. Who can do this? Who can do this? This is mutual funds. These are mutual funds buying here. So the poor small investors investing in a small 401k or a smaller 1k, whatever you want to call it, he has a mutual fund manager that's more concerned with sending out a statement showing that he didn't own Google this past quarter than he is concerned about preservation of capital. You're crazy to invest in mutual funds. Please, do your own research. Make your own decisions. Invest your own dollars. Stay away from these mutual funds. If you're in a 401k, I understand you're forced into it. Become a more proactive manager, please. I beg of you. Don't trust these guys. They're hoodlums. They're charlatans. Please don't trust them. Now on to the XLF. Okay. As I always say, as go the financials, so goes the rest of the market. And you can see that we're bumping up against resistance here at the 15 level. We had a little bit of a pullback late last week. We are still above the weekly trend line, so the uptrend is still intact. We could still see higher highs on the XLF. The RSI, the trend is still in effect. You still have you have the RSI is solid. It looks good. I wish I could poke holes in this. I can't. It looks solid. Here's where the weakness comes in, and this is significant. Look at the declining up volume. Look at this. Can you have fresh money come in next week and spike the financials higher so it'll get the S&P 500 moving higher to the 1100 level? Absolutely. I wouldn't put anything past these guys. But please don't let it be you. Be smart. You should start right now thinking about as they start to send this market parabolic into the 1100 level into hard resistance. You should be thinking about taking money off the table, not putting new money on. You should be thinking about adding to your short positions, not putting new money on. Take your profits because believe me, that's what the big institutional money was doing last week, and they were doing it in the transports. Let's take a look at the transports here. Yeah, the transports that were up slightly last week, but and take a look at it's going right into resistance here. But take a look at the volume. The volume picked up. Ideally, you see this type of volume uptick. You want to see a full body, a candlestick body, to coincide with that up volume. You didn't get that. You have very little movement. What that tells you is that for every buyer, there was a seller. For every buyer, a seller. There was churning going on. So you had people rotating out of the transports. Can it change next week? Could it have been a bottleneck? Absolutely. Could spike up next week. You never know. Okay? But these are just warning signs. So keep an eye on it, and just pay close attention to it. The XLU. The XLU, it's a proxy for interest rates. Remember, utilities need to borrow money. They need to float bonds. So they're very interest rate sensitive. They need fresh capital coming in all the time for maintenance, expansion, etc. So once you start to see the utilities weaken, you can expect the rest of the market to follow. In anticipation of watching the utilities roll over, you can keep an eye on the 10-year bond. Note how you're beginning to see this nice consolidation pattern form here. This is the yield. This is not the bond price. This is the yield that those bonds must pay. So as the yield gets higher, the value of the bond declines in value. So you keep in mind that you have the Chinese who are supporting us. We are on the teat of the Chinese for our very existence right now. They have already begun diversifying out of treasuries and into shorter dated maturities, like the 10-year or 2-year notes. So you're going to see a lot more emphasis placed on these 10-year bond yields. And traditionally, once you see that yield rise above 4%, you can expect that the Chinese are going to start clamoring that the value of their bond holdings is declining, and they're going to demand more interest payments on future investments. And if they sit out one of these bond auctions in retaliation for last week's tariffs on tires, brother, you're going to see this market just roll right over. So please keep an eye on that. Keep an eye also on the Baltic Dry Sea Index. Remember, it's been technology, financials, commodities that have kept this market going. Now, if you had the transports last week, I'm sorry, it wasn't transport, it was you had the financials last week that were up 4.5%, yet you had the Baltic Dry Sea Index down 4.5%. What gives? Remember, as goes the financials, so goes the market. So if there's so much demand from China, why is the Baltic Dry Sea Index look like it's going to break support here? I ask you. If you see the Baltic Dry Sea Index break support here, you can expect the rest of the market to take notice, and you're going to begin to see a sell-off in the financials and in the commodity names, because it's a dollar play on the commodity names. It's not the demand play. And if the dollar begins to strengthen on the back of strengthening treasury yields, then you're going to see the market decline. So please keep an eye on it. Last week we went short the FAZ, which is the Direxion here, the Direxion Daily Financial Bear 3x shares. Now that means that for every 1-point move on the Russell 1000 Financial Services Index, this ETF, the FAZ, moves 3 points. So be very careful. This is not for the faint of heart. If you don't have the stomach for this type of trade, short the XLF. It's a lot easier, and you'll sleep a lot better at night. So please use caution, folks. We're going to be taking profits in the in AXL next week. We have a 652% profit, and For everybody else, I will be sending out an alert to all our subscribers. For everybody else, please, if you want to join the Contrarian Trader, visit the website, take advantage of the 14-day free trial offer, and I'll talk to you soon. Have a great weekend. Bye-bye.